really excited to welcome somebody who I've learned an absolute ton from. Brandon Hall is a certified public accountant, a national speaker, and the founder, CEO of the Real Estate CPA. Brandon works with real estate investors, syndicates, and private equity funds to optimize tax positions and streamline accounting and business functions. He believes that real estate investing is critical to building sustainable and generational wealth. Brandon invests in multifamily properties personally and through his capital group, Naked Capital. Welcome, Brandon.
Thank you, Dave. I appreciate you having me.
Where did Naked Capital come from, out of curiosity? Why is that the name you went with?
It was actually one of my clients ended up wanting to partner with me on syndications a few years ago, and his idea was transparency in the syndication space, and so he's like, "We'll be Naked Capital, very transparent."
Gotcha. I was wondering that. I normally think of somebody Naked Capital, I think of someone not doing terribly well, but that makes a lot more sense.
Yeah, I guess you could look at it on the other side of the coin too. Yeah, we didn't really think about that. We just thought, oh yeah, transparent, naked. That makes sense.
Okay, fantastic. So I've listened to a ton of things that you've said. I've listened to a lot of your talks. I've read a whole bunch of your posts on Bigger Pockets, and tends to be in fairly technical stuff. I associate you as that guy who comes in when somebody has a complex question and you like to come in and answer that. You've been incredibly helpful to the community on Bigger Pockets, which is a fabulous real estate forum for anyone who doesn't know. But I really want to make sure we're not hitting that super complex stuff at this point. I wanted to have like a good kind of overview. Why is real estate investing so incredibly powerful tax-wise? And if we could just hit some of the real key points that somebody investing maybe in their first real estate investment or looking at expanding themselves into becoming a more serious investor really wants to make sure that they're aware of.
Yeah, well, real estate is powerful from a tax perspective because you can create a cash flow stream and a wealth building asset that you never have to pay tax on if you structure everything appropriately, and that's really where the power comes. So, if I look at the stock market and I'm investing in the stock market, and maybe I'm squeaking out a 10% return annually over a 30-year period, well, that's my before tax return. My after tax return might be like 7% or 8% or something like that. When we're talking about real estate, my before tax return could be 10%, and then my after tax return could actually be 12% or 13%. It goes up because real estate can create losses that I can utilize against my taxes. But even if you can't utilize the losses, it's still extremely powerful because you are creating these tax-free, effectively income streams. You're kind of taking the Warren Buffett approach to building wealth. Warren Buffett, he's always been talked about as having a lower tax rate than his secretary. Right. It doesn't mean that Warren Buffett doesn't pay taxes. He pays millions in taxes, but his taxes compared to his total income, that's his effective tax rate. That's lower than his secretary's. And so real estate allows you to do that. If I have a $100K salary and then I buy two properties that cash flow $10K each during the year, meaning that now my total income is $120,000. If I don't pay tax on the $20,000 in rental income because I've structured appropriately and I've mitigated my income from tax, it doesn't mean that I haven't earned the $20K. I've still earned the $20K. I'm just not going to tell the IRS that it's taxable income. So now I'm still paying tax on my regular $100,000 W-2 job, but I've actually earned $120,000. So my effective tax rate is decreasing. If I can do that 10 more times, now I'm in the $200,000 total income range, but I'm only paying tax on that first $100K, my W-2 salary. That's why real estate's powerful. It allows you to accelerate the wealth building over time as you continue scaling your portfolio because you don't have to pay tax on the income stream if you structure it appropriately.
So I guess I'm asking the question, why is that? Why is there this vehicle where we're able to make so much money and legally claim that we're actually losing it?
Well, the government wants you to invest, right? They want you to build wealth and build savings over time. And real estate is an asset class that they allow you to do that in. So.
And it seems like one of the most powerful one is depreciation, which is really a mind-boggling concept to me. Like literally you can buy a property for $100,000. It can go up to $200,000. But yet, as far as the government's concerned, you're able to claim that it's been going down?
Exactly. So depreciation is, the concept is based on the fact that when you buy a property, it's going to deteriorate over time. The components of the property will wear out over time. And that's what depreciation is meant to track. So it's not meant to track the increased asset value. It's just meant to track the components being worn out. So my roof is going to, start leaking in 25 years type of thing. So what they've done is they've said, when you buy a property, you have to calculate the land value. If I buy a property for $100,000, the land value might be $15,000. And that means that the building value is $85,000. I then depreciate that over 27 and a half years. Why is it 27 and a half? That's the number that they picked. But 27 and a half years, the entire $85,000 is depreciated over that time frame. And that probably comes to $3,000 a year or something. Now that $3,000 a year, I don't have to keep paying for the $3,000 a year, right? I bought the building up front and I just get a free $3,000 tax deduction every single year. So if my cash flow on this property is $2,000 and then I have $3,000 worth of depreciation, I'm actually going to get to go tell the IRS that I lost $1,000 for tax purposes. That's how depreciation works. And that's why you can build a real estate portfolio and not pay tax on the cash flow.
Now, you can claim the loss sometimes, but depending on how you've earned your income, sometimes you can count that as a loss and use to eliminate income, and sometimes you can't, correct?
Yeah. So by default, all rental real estate is a passive activity. And a passive loss can only offset passive income or gain on sale from another passive activity. So I could sell rental A and I could sell it for a gain. And rental B could generate a loss that can offset the gain when I sell rental A. So that's how you use the passive losses. Now, if I don't have passive income, or if I don't sell one of my passive activities for a gain, and I'm creating a passive loss for my rental real estate activities via depreciation, then I'm going to create a suspended passive loss, and it's going to carry forward indefinitely. It doesn't expire. It's just carried forward forever until you either generate passive income or sell a passive activity at a gain. And there's two exceptions to this rule. So again, by default, all rentals are passive. And the two exceptions are, if you earn less than $150,000, you can take up to a $25,000 loss allowance. And that $25,000 begins to phase out at $100,000 in earnings and is totally phased out when you earn $150,000. That's exception number one. Exception number two is qualifying as a real estate professional. And if you qualify as a real estate professional, and if you materially participate in the rental activity, then what you're doing is you're basically saying, I don't have a passive activity anymore. I have a non-passive activity. And that non-passive activity is what everybody's gunning for in real estate. Because if I can claim my losses as non-passive, going back to that example where I bought the $100,000 property, I've got $85,000 building value, $3,000 a year in depreciation, $2,000 cash flow, so a $1,000 taxable loss. Well, if I'm a real estate professional and I materially participate in my rental activities, that $1,000 loss is non-passive, meaning I can take that loss against any other income that I earn. My spouse's income, my capital gain income, stock income, whatever it is. It's a non-passive loss. And then we get into the fun stuff where we get to accelerate the losses that you get to claim in those years, right, especially early on, which I don't know if we'll talk about, but yeah.
We have a whole talk with Yona Weiss going over the cost segregations where he goes into all of that. But the whole real estate professional thing really blows me away. And this is something I actually learned very recently. And I just the other day, in fact, actually told one of my siblings about this, because we've got a situation with somebody who is a fairly high wage earner, and one spouse, and the other spouse is a stay-at-home parent. And so it's one of those things where, wow, one person earns a ton of money and the other is earning very little, if anything. And what I learned from this is that, if the other spouse gets real estate professional status and they have a lot of losses, they can generate a lot of losses from real estate. It could wipe out a huge percentage of the tax burden from the other spouse who's making a really strong living.
Absolutely. One spouse can qualify as a real estate professional. The other spouse could be working full time. So we often work with a lot of high net income, high net worth individuals. physicians, people in the tech space out in San Francisco, and they're all earning five, six, 700, $800,000, but their spouse is staying at home, so we'll get the spouse to qualify as a real estate professional. I should caveat this and say that qualifying as a real estate professional is nowhere near as easy as the books will make it seem, and other folks might make it seem. It is difficult to do. You have to spend 750 hours and greater than half your time in a real property trader business, and that's you have to document it, and it's hard to do. And a lot of people will say, "Oh, I can just take education and I can watch things and I can research property, and that'll hit 750." None of that time is going to count. None of that time is going to count. You have to actually manage the property. You have to be touching it. You have to be collecting rents, managing the tenants, managing the rehab. And so it is a little challenging to achieve. But if you can achieve it, you can definitely take some pretty significant losses against your income, and the tax refunds can be pretty large.
Wow. So I know I've seen some of Brandon's things on this point. It's a complex area, and I highly recommend the people who are interested in that area contact Brandon and look at all the materials that he has on becoming a real estate professional, because it is a whole big area, much bigger than the scope of this conversation. Let's get into some of the kind of the nuts and bolts that everybody needs to know. You mentioned you can sell a property and actually not have to take a gain if you buy another property.
Yeah. So what you're referring to is a 1031 exchange. And 1031 is just the Internal Revenue Code section that this lives in. So it's section 1031 of the code. And basically, if you've held a property for a while and you've got this large built-in gain, and you want to sell it, and maybe you want to buy a bigger property, or you want to buy, maybe you have a multifamily property and you want to buy a commercial property, then you can do a 1031 exchange, which allows you to effectively roll the gain over through this process and not have to pay tax on it. So a lot of our clients will 1031 exchange over and over and over. And through the course of 20 years, you started out with a little single family home and you end up with a $3 million apartment complex or a $3 million office complex. That's on a triple net lease and very easy to manage going into retirement. So 1031 exchanges just allow you to take whatever gain you would have otherwise had to recognize and roll it into the next property.
Is that ever going to come back to bite you, or are you just kind of pushing off something that is going to come back to haunt you later on?
If you sell it at some later point and you don't run a 1031 exchange or some other sort of tax deferral method, then yes, you'll have to, at that point, recognize the entire gain that's been baked into this as you've rolled over property through the years. And that could be pretty expensive from a tax perspective.
But I heard a talk from one of your partners who said 1031 till you die. He said that, just if you just keep pushing it and just keep pushing it, it'll never catch up with you. But want to catch up with your heirs?
Good question. So when an owner of a real estate asset dies, the heirs receive a stepped up basis in the asset, meaning that the heirs inherit the asset at the market value, the fair market value at the date of death, which also means that all the gain and everything that you've previously accumulated gets wiped out. And it's important to understand the concept of basis here, because that's what this whole thing relies on, stepped up basis. If I buy a property for $100,000, my basis is $100,000. If I depreciate it by $10,000, now my adjusted basis is $90,000, right? So my basis has decreased. If I could then later sell the property for $200,000, that's the fair market value, I have to take that fair market value and subtract my adjusted basis to get the total gain. So if my adjusted basis is $90,000, and I can sell it for $200,000, then my total gain is $110,000. And if I didn't sell the property and instead just died and passed it on to my heirs get basically take that adjusted basis and they step it all the way up to fair market value. So $200,000, they can then immediately sell it for $200,000. And because their adjusted basis is $200,000, their gain is $0. So when you 1031 for like 2 decades, you might have built-in gain of like $2 million. But if you were to pass away and pass the assets on to your heirs, then all of that just disappears because they get to inherit it at the current fair market value, meaning they could sell it right after you pass away and have zero gain.
Now, if they don't sell it, let's say it's been 27 and a half years since you bought it until you die. You've totally depreciated it. There's nothing left. And you die at that point, and it passes on to your heirs and they don't sell it. They can just start the depreciation all over again, can't they?
Right. So their basis is it's almost as if they purchased the property themselves. That's a better way to think about it. They purchased the property themselves, whatever the fair market value is at the time of death. So if we use this $200,000 example, they get it at $200,000, and that's their basis. And now they can start depreciating it over 27 and a half years at $200,000.
Even though their parent already bought it 27 and a half years ago at 100,000, depreciated all of that, they get a brand new set of depreciation. They get a brand new basis, no 1031s built in. That's it. It's kind of incredible. Makes you wonder why you'd sell.
Well, and many of our clients don't. And so why you would sell is you get into the retirement age and you want to start liquidating, right? You want to start enjoying the nest egg that you've built out. And so oftentimes we'll run into clients wanting to do one of two things. They'll say, well, I want some cash to play with, or I want it, so I need to sell to create that cash, or I need to restructure my portfolio to create the income that I'm looking for, and I'll be fine just living off of that. And if you can have that conversation earlier in life, you can build a portfolio out that really just drives the income for you. Because if you can just leave the nest egg alone and just pass it on to your heirs, now you've created this generational wealth, or a really good starting point for it. But another reason that we see people sell too is the heirs don't want real estate, or they're not good at it. They're going to ruin the empire that you built, and that's a serious consideration that you need to think about. So there are some reasons to sell before death, but it's all part of that estate planning conversation.
So it sounds like if somebody they know they're dying soon and they've got heirs who don't want to be in the real estate game, then it might actually make sense, rather than for them selling and leaving money, it might make sense for them to say, hold on to it until I die, and then you sell it, because you won't take this huge tax hit that I would take if I sell it before I die.
Yep. Or have the executor sell it. Like oftentimes we'll see the parent passes away and there's this mad squabbling. We see that actually a lot in real estate, because everybody will get a slice of the property. So I'm not going to get the full 200K. I'm only going to get 5 or 10% of the 200K or whatever, depending on how many heirs there are. Well, I might want to sell, but the other heirs might want to hold it. So now what do you do? Right. So there's some really interesting estate planning considerations that do need to be talked about.
Okay, awesome. Let's talk a bit about selling one's primary home. Now, if you've had a home and you moved on, it's not quite the same thing as if you had another property that you were renting out to others as a commercial investment, correct?
Right. Yeah. So when you have a primary residence, and if you're renting out half of that, they call that house hacking on BiggerPockets. Have you heard of that?
Yeah. Craig Kurlop, who wrote the house hacking book, he's also in this. We had an interview with him.
Good. Yeah. So whenever you're house hacking, it's actually pretty complex from a tax perspective, because you have to divide the house up between personal use and business use. Right. You depreciate a portion of the house. You take a portion of all the general expenses like insurance, property taxes, and that type of thing, and you have to put it on Schedule E. The other half goes on Schedule A. So it can actually get really confusing for landlords, but it's a really good way to live relatively free, have somebody else pay your mortgage,
But aside from the house hacking, let's say you just had a single family home that you lived in for 2 years, and then you decide to sell it, and you make, say, $300,000 more than you bought it for. What's your tax burden going to be like in that scenario?
Oh, I see. Okay, yeah. So Section 121 exclusion, that's what we're talking about here, and that's the section of the tax code, Section 121. What that allows you to do, if you're single, you get to exclude $250,000 of gain on sale from a primary residence. If you're married, it's $500,000. Married filing joint, it's $500,000.
Right.
The rule is that you have to live in the property for the past 2 out of 5 years. And if you're in the military, you get some extensions on that rule, which I'm not going to go into. But Section 121, 2 out of 5 years. So I can live in a primary residence for 2 years. I can rehab it during that time, and then I can move and I can rent it out for 3 years. And as long as I sell it by the end of that third year, I can exclude $250K of the gain, or since I'm married, $500K of the gain. We actually have some clients, and myself included, that will buy property and then every 2 to 3 years they'll move. So my spouse and I, that's what we do. We go and we buy a primary residence that needs some fixing up. We've bought like rent properties that used to be rental properties from these owners, and we'll go buy them, we'll fix them up, and in 2 to 3 years we'll move and we'll do the next. We'll do it again. But we're selling the properties, and we're not paying any tax on them because we're sheltering the gain. And you can do this every 2 years. Every 2 years, you can apply this exclusion. So it's
Wow.
pretty powerful.
Yeah, it's $500,000 every 2 years is pretty good.
We haven't hit that, but yeah.
Haven't hit it.
Ours are a lot smaller than that, but we're still not paying tax, so that's nice.
Right. Now, you talked about doing improvements. Now, I understand there's a couple different ways that you're able to classify improvements. Say you own a rental property and that they have some pretty big tax implications.
Yeah, so when you own rental property, you have to, whenever you're doing any sort of repair or rehab, you have to figure out, is this expenditure a repair or is it an improvement for tax purposes? Doesn't matter what you think, doesn't matter what the property manager thinks. What matters is when I look at the Internal Revenue Code, what's the result? So there's something called the 2013 Tangible Property Regulations, and those regulations tell you how to treat expenditures for tax purposes. And what I like to tell people is it's not necessarily about the dollar value, because I could buy a 10-unit apartment complex and all 10 units have an HVAC system attached to them. So we have 10 HVAC systems. If I replace 2 HVAC units, maybe that costs me, I don't know, $10,000. I replace 2 out of the 10. Most CPAs will look at that and say, oh, that's pretty expensive, right? $10,000 is a lot of money. So we're going to put that on the balance sheet, meaning that we're going to capitalize it, and we're going to depreciate that over 27 and a half years. Our team would look at that and say, well, when you apply the 2013 Tangible Property Regulations, replacing 2 out of 10 HVAC units in the entire system is not a material improvement to the HVAC system as a whole. Therefore, we can deduct these 2 HVAC units today as a repair, meaning that we get to take the entire $10,000 as an expense today rather than depreciating it over 27 and a half years. And sometimes when I tell this example, people go, whoa, no way, but this is actually an example in the Internal Revenue Code, this specific example. So you can do it if you apply the 2013 Tangible Property Regulations correctly. But here's so not only do I get to take the $10,000 as an expense today, which is obviously beneficial, more beneficial from a time value of money perspective than spreading it out over 27 and a half years. But here's the other thing. When I sell this property at a later point, I have to remember that whole adjusted basis conversation we just had a minute ago. You know, if I buy a property for 100 and I depreciate it by 10,000, and I have $90,000 adjusted basis, and I sell it for 200, now my gain's 110 rather than 200 minus my original purchase price, which would make the gain 100. So I have to recapture the depreciation that I've taken at some point, right? My adjusted basis goes down as I depreciate. And then it's whatever I sell the property for minus my adjusted basis. That's my total gain. So if I'm depreciating these HVAC units over time, all I'm doing is driving my adjusted basis down, and I'm going to have to recapture the depreciation at some point when I sell. Versus if we take it as a repair today, there's no recapture to claim at some later point.
Wow. So it's not just the fact that you get to spread it over time. It's the fact that you just get to take that money out of the picture entirely. It's not part of the 1031. It's not part of the depreciation recapture.
Yep, absolutely.
So as much as possible, anything you can declare as a repair legally, anything you can get away with calling as a repair rather than improvement to the property, you want it to be a repair.
The only time that I would say that would not be the case is in a year that we have multifamily property or commercial property and we are trying to sell it, or we're planning on selling it next year. In those, when you are moving towards sale, it's better to increase your net operating income. So if I have a $10,000 HVAC expense that I could capitalize if the 2013 Tangible Property Regulations allow me to, right? It's not always a choice. You might have to do it one way or the other. But if I could capitalize that $10,000 versus deducting it today, then that's actually going to increase my net operating income because I'm not going to have a $10,000 expense that I'm taking today. I'm going to have $10,000 divided by 27 and a half. That's going to be my expense. So it might make my asset look like it performs better than it really does.
Gotcha. So we shouldn't necessarily assume that these buyers are savvy and can understand numbers. That playing with the numbers a bit can actually help show different valuations.
Well, I don't know. I mean, a lot of the so we work with a lot of the sponsors on these big syndication deals, and they are very big on net operating income. They want to make sure that 2 years prior to sale, that their net operating income is the highest it can possibly be, because that drives the value of the property at the end of the day. That drives what buyers will pay for it. And so the smart ones come and talk to us about it, and they go, well, what's our plan to increase net operating income? We're saying we're going to capitalize everything that we can possibly capitalize and put on the balance sheet. Because if we're not deducting it today, then your net operating income is that much larger.
You'd mentioned a bit earlier, we were talking about somebody who might be looking to get more money after retirement, and so they might be tempted to sell rather than hanging on. What happens if they just decide to refinance, take a home equity line of credit, something along those lines? What are the tax implications of doing that rather than selling?
We love it. Absolutely. People cash out refinance all the time. They'll do a rehab, then they'll hold the property as a rental, and then they'll cash out refinance. They'll pull their equity out, and that's a non-taxable event. So you can 1031, 1031, 1031, and then pull all your equity out. Whatever your lender will let you take out. And that's a non-taxable event for people. Now, the next question is, well, what about my interest expense? Can I deduct it? And that is where it's a big question mark. Mm-hmm. So that depends on what you actually do with the debt proceeds. If I take money out of one of my rentals and I go buy a Ferrari, well, that's a personal expense, right? And I cannot take the interest associated with that purchase.
Even if I drive it to look at my properties?
Yeah, even if you drive to look at your property, it's not going to allow a Ferrari. You got to buy a truck or like a Tesla Model X that squeaks right above the $6,000 or the 6,000 pounds, which we don't have to get into. But if you take equity out of your rental and then you go buy another rental or you start a business with it, now the interest expense is deductible.
Okay, awesome. So that's certainly an interesting thing to think about. Well, as long as we're on that interest and what's deductible, what's not. So what of my interest, if I wind up buying a property as either as a residence or as a commercial property, what is deductible in terms of the interest? What is not?
So when you apply proceeds, when you apply debt proceeds for business use, whether it be buying rental property, commercial property, or just like running a business, the interest expense is a business expense, meaning it's fully deductible. So
what about a residential property? Somebody just owns their primary residence, so can't they also deduct the interest on their mortgage?
Yeah, they can. And there's limitations with the 2017 Tax Cuts and Jobs Act that came into play, and there's limitations on HELOCs now too. But what a lot of people don't realize is, like, I could take a HELOC out of my primary residence, and then I could take the debt proceeds and buy a rental with it, and the interest expense is now associated with the rental property, so it's deductible on the rental property.
Gotcha. For anyone who doesn't know, HELOC is a home equity line of credit.
Yeah.
So I just want to make sure we cut through some of the jargon. All right, let's hit a few of these other, just quickly, a few other really good points that people should know in terms of tax deductions. You mentioned, home office, travel, meals, supplies, all of these things. Can you touch on some of these points and how they actually factor into your whole tax equation?
Sure. Yeah. So everybody needs a home office for a couple of reasons, but one, it's like one of the, I don't want to say it's one of the easiest deductions to claim. There's a safe harbor for the home office deduction now that the IRS is granting taxpayers. You do have to legitimately use the office for business purposes, not for personal use purposes. So that is the one caveat. You don't have to have an entire room for your home office. It could just be a corner of the room, and you could deduct a corner of the room as your home office. So we work with our clients on making sure that it's set up appropriately and making sure that we are in line with the regulations. But the better thing about the home office is that when you have a home office, you have a place of business at your home. So when you go and travel to the rental properties or anywhere else, now it's not a personal commute. Now it's actually a business commute. You're going from business office to business office rather than personal home to business office. And so that's one piece of contention a lot of people forget about. But yeah, mileage to and from is going to be deductible. Any sort of travel that you run is also going to be deductible. And there's a lot of different travel rules that we can jump into and a lot more detail. But yeah, I mean, if you legitimately have a business need to travel to a location, then you can deduct that trip. What's typically not going to count is going to be like going to networking events or conferences, and that's not really an operational need unless you've built a business, a large business with employees, and they need to go there to increase their skill set or something. But most of our landlord clients, you're not going to be able to justify, a week in Hawaii at a mastermind group. There's no real business need with that type of travel. Though
Okay,
many
awesome.
people argue.
And it used to be that meals could be fully deducted if you had a business situation. Now it's only, is it 50%? Is that right?
It's 50%. Yep. So if I have a business meal, I can take 50% of the value and deduct that. Yep.
And the rationalization there being that you need to eat anyway. So if you weren't eating in a business meal, you'd still need to have like a meal somewhere.
Yeah, well, I have to discuss business. It has to be a business purpose. So I have to discuss business either immediately before, during, or after the meal. So I can't just go to McDonald's and, snag whatever and say that that's a business meal. It has to actually be a business meal. So who are you taking with you? What are you discussing immediately before, during, or after the meal that is business related? Now it's a business meal.
Okay, awesome. It seems like there's so many little tips and tricks and nuances of this whole game of really mastering the whole tax picture when you're doing real estate. So there's far too much that we can cover in one little talk. So if somebody wants to be digging into all these things, if they want to figure out how to be taking advantage of all of this, I often tell people there's two kinds of accountants. There's a type you go to at the end of the year after you've done everything, and they kind of count everything up and they submit it to the IRS. It's more like the bean counter, role where you just tell them what you did and they tell you how much you owe. And then there's those who actually help you figure out strategically in advance what you want to do to make sure that you don't really have much or any of a tax burden at the end of the year. And I know you definitely fit into that second category. So if somebody wants to dig a lot deeper, figure out how they can plan intelligently for taxes, how can they connect with you?
You can just go to www.therealestatecpa.com. We have a become a client form on the website if you want to fill that out. And we also have a 10,000 word tax guide also on the website. If you go to the website, hover over education and click ultimate guide, you can read through that. But that we've found our feedback has been that's been pretty incredibly helpful for a lot of people. So.
Okay, awesome. And certainly everything you've shared is already incredibly helpful. So thank you so much, Brandon. It's been a pleasure talking to you today.
Thanks, Dave, for having me on. I appreciate it.